Pressure is rising at the Federal Reserve Bank. President Trump has been demanding lower interest rates, but the Fed has said no time and time again because the Fed is concerned about tariffs and they're concerned that it's going to make inflation worse. Well, now things are escalating because we got a new report saying inflation, core inflation, has come in hotter than expected, and it was the highest core inflation that we have seen in 6 months. Now, you might say that because of this new inflation reading, the Federal Reserve Bank is going to be less likely to cut interest rates. Well, it turns out that's not the case because the pressure is rising. President Trump is now threatening a huge lawsuit against the chairman of the Fed because of the renovations on the Federal Reserve Bank building, but it could also partially be because President Trump is not happy with the way that the Federal Reserve Bank is handling interest rates, and that's why today I want to break it all down because interest rates are the blood of our economic system, and it can impact the stock market, it can impact the housing market, it can impact your money. So let's break it all down. Remember, the Federal Reserve Bank is the central bank here in the United States. And although they're called the Federal Reserve Bank, they're actually not a bank because you and I can't go there to deposit money. They're not a reserve because they're not sitting on any cash reserves, and they're technically not federal. It even says so on their website. But they have the ability to raise and cut interest rates depending on what's happening in the economy. And generally, the Federal Reserve Bank wants to cut interest rates when they want to stimulate the economy. So you cut interest rates when you're in a recession or a slow economy. And then you raise interest rates when you are worried about inflation or when you want to cool the economy down. Well, here we are in a strange economy. We got a recent report saying that our economy is growing faster than expected in Q2. In Q1, it said that our economy is growing slower than expected, but there are concerns about the economy, and there's concerns that these higher interest rates are making it difficult for people to buy houses and buy cars, and that's why President Trump keeps demanding lower interest rates. But the Federal Reserve Bank says, no, we don't want to cut interest rates because there's all these concerns about tariffs. And if tariffs do impact the prices of things, that will make inflation worse. And if we couple that with lower interest rates, we could have a real inflation problem that we don't want to deal with. That's why the Federal Reserve Bank has been staying firm. And this has been creating a big feud between the Federal Reserve Bank and President Trump. And if you've been reading Market Briefs, you already know about this. Again, Market Briefs is our free financial newsletter where every day my team is publishing what's happening in the economy, housing, stocks, crypto, and global markets into a fun, witty, and easy to read email. You can read it in less than 5 minutes every morning, and it's completely free. So if you have not joined Market Briefs yet, well, you can join by clicking the link down in the description below. And as an added bonus, when you join Market Briefs, you'll get a free investing masterclass as a complimentary bonus just for joining. Well, now this brings us to what's going on today, because there's a lot of concerns about what the Federal Reserve Bank is going to do next, because the Federal Reserve Bank is going to meet on September 16th and September 17th to decide what they're going to do with interest rates. And right now, Wall Street very confidently believes that the Federal Reserve Bank is going to start cutting interest rates in September, even though inflation has come in hotter. And this is where a lot of people are confused as to what to expect. But let me show you what President Trump has been saying. This is what President Trump posted on Truth Social. Quote, "The damage has been done by always being too late and is incalculable. Fortunately, the economy is so good that we've blown past through Powell and the complacent board." By the way, Jerome Powell is the chairman of the Federal Reserve Bank. "I am, though, considering allowing a major lawsuit against Powell to proceed because of the horrible and grossly incompetent job he has done in managing the construction of the Fed buildings." Now, the reason why I want you to understand this is because I said a minute ago that the Federal Reserve Bank is not federal. And the reason why that's important is because they're technically not a part of the United States government, which means President Trump can't easily fire him. And so when President Trump wants lower interest rates, he can ask for it, he can put pressure on him, but he can't just remove the Federal Reserve Bank chairperson. And that's where now President Trump is trying to get creative and put additional pressure on the Federal Reserve Bank. And it seems like these lawsuits for the way that the Federal Reserve Bank is handling the renovations of their building could be a threat to entice them to want to cut interest rates sooner rather than later. And that could be one of the reasons why Wall Street is anticipating that the Federal Reserve Bank is going to start cutting interest rates in September. But This is where you want to understand the implications of lower interest rates, and you want to understand the implications of all of this. Now, it doesn't matter if you believe that we should have lower interest rates or higher interest rates. All of that is opinion. I want you to understand how all of these things create opportunity, because the reality is President Trump wants lower interest rates. And Jerome Powell, who is the chairman at the Federal Reserve Bank, is going to have his term expire in 2026. Well, when his term expires, it's very likely that he is going to be replaced, just based off of the things that we've heard from President Trump. And if he's replaced, President Trump will probably want to replace him with somebody who is much more likely to cut interest rates aggressively. So whether or not we see aggressive interest rate cuts in 2025 really doesn't matter too much, because there's a very high chance, based off of what we hear, that President Trump is going to replace Jerome Powell in 2026 with somebody who is going to aggressively cut interest rates. So we can anticipate that in 2026, we will likely see lower interest rates. Why? Because President Trump will likely replace Jerome Powell when his term expires with somebody who will want to do that. When you see these lower interest rates, there will be certain changes in the economy, and there will be certain changes in the stock market. And those are the things that I want you to start paying attention to as a financially savvy investor. Because what every savvy investor wants to understand is, when you have these types of changes and movements, where is the money moving? Where does this create opportunity? And the first thing you have to understand is that if you have money saving somewhere, sitting in a high yield savings account, chances are you are going to see the interest rate that you're being paid get cut. How much? Well, it depends on how much interest rates go down. If we have to take a guess based off of what we know, chances are we won't see a huge cut in 2025, but we could see more aggressive cuts in 2026, depending on who Jerome Powell is replaced by. The second thing is that lower interest rates change the cost of borrowing. And yes, this can impact the mortgage rate that you pay. This can impact the car loan rate that you pay. This can impact all those types of consumer debts. But the other types of debt that this really impacts is corporate debts and our national debt. And I made a video talking about this last week, which is that the United States government is the largest borrower out there, with about $37 trillion or so of national debt, and it's going up every single day. And the reason why these interest rates matter is because the United States government has to pay interest on this $37 trillion plus of national debt. And when interest rates are higher, that means the United States government has to pay more interest payments on all that debt. Well, where does the United States government generate this money to pay for all of their debt payments? They get their money from taxpayers through tax dollars, which means when you go to work and you get paid and you pay taxes, that money goes into the hands of the United States government, and then they pay for the services, but a lot of the money is being used just to pay for interest. And this is where President Trump is saying, hey, if we can get lower interest rates, we can then refinance the United States national debt at a lower interest rate. That way the United States government can save money on interest payments, because right now the fastest growing expense for the United States government is not our military, is not healthcare, it's not infrastructure, it's not technology, it's interest payments. And that can be a concern, because interest payments really don't provide any service for people. That money has already been spent. It's just money now being used to pay back our previous expenses. And the United States government does not follow a balanced budget, which is spend less than what you make. It's spend money, generate whatever you can generate in taxes, and then borrow money for everything else. And that's why we have all this inflation problem, because in order to fund all that debt, the United States government then goes out and borrows money from the Federal Reserve Bank, and the Federal Reserve Bank is not sitting on any cash reserves, so they have to print that money and lend it to the United States government. And anytime you print more money, the value of each individual dollar goes down, causing the prices of things to go up. So when you hear these lower interest rates, yes, it can impact your savings account. Yes, it can impact what your mortgage rate will be. And yes, if we do see an aggressive drop in mortgage rates, you'll probably see a surge in refinances. Maybe we would see a surge in buying. Maybe that would cause housing prices to go up. But the other thing you want to think about is from a national level. Now, the other part that I want you to think about here is also for corporations, because corporations do not have a 30-year fixed rate mortgage. In fact, many corporations that have debt have 3-year, 5-year, or 7-year loans, which readjust. And during 2020 and 2021 and early parts of 2022, we saw a huge influx of new debt. Corporations were taking on more debt than ever before because it was the lowest interest rates in the history of time. So pretty much every corporation with debt was borrowing money or borrowing as much money as they could because it was low interest rates. Well, in 2025, we're starting to see a lot more of those interest rates readjust, which means now corporations have been seeing their costs rise. Not just because of inflation, not just because salary costs are higher, not just because software costs are higher, not just because rent costs are higher, but because their debt servicing costs are higher because of the higher interest rates. And so a lot of corporations, you can imagine, have been putting pressure on the government and the Federal Reserve Bank to get these lower interest rates because it's causing a lot of corporations to go bankrupt. In fact, if you look at the bankruptcy numbers, we've been seeing some of the highest corporate bankruptcies in 2025 that we have seen since the tail end of the 2008 Great Financial Crisis. So we're seeing a lot of bankruptcies happen. And no, it's not just because of interest rates. Some might be because of tariffs. Some might be because of inflation. Some might be because of other factors in the economy, slowdowns in the economy. But you have to imagine that interest rates are playing a part in that as well. That's why I want you to pay attention to this, because lower interest rates will have an impact on many different parts of the economy, and generally lower interest rates to stimulate the economy because they makes borrowing money cheaper. And when you make borrowing money cheaper, people can then go out and spend more money. And when people spend more money, that helps the economic system because our economic system runs on spending. And don't care if you're spending money that you have in the bank or if it's spending money that you have on your Amex or Visa. You spend money and the economy grows. I'm not saying that's the right thing. I'm telling you that's how the economy works. You should not go out and spend money on debt to buy things that don't put money in your pocket. Okay? Finance 101. If it doesn't put money in your pocket, do not finance it. The exception being your house. But I want you to understand how the economy works. Now, from an investor standpoint, can this create opportunities? You bet. Because there are certain companies that will benefit from lower interest rates. Things like lenders, things like banks, and this has been talked about in the news very recently, but you might have seen that certain lender-related companies have been seeing a lot of growth recently because investors are anticipating that once we start to see lower interest rates, people will want to refinance all of their debts, all of their car loans, all of their mortgage loans, and that's going to create a surge in refinance revenue. Now, what will happen, I don't know, but these are the things I want you to think about because what Wall Street wants to know is where's the money moving, and I want you to start thinking like an investor. That way you can stay ahead of these types of opportunities. Again, we're keeping you posted on market briefs. That way you can stay up to date on what's happening. And with that, I will see you on YouTube tomorrow.